Well, welcome to class, everyone. My name's David Elliott. Some of you know me as First Wave, and for the next 4 or 5 or 6 hours, we're going to talk about the markets, technical analysis. We're going to be covering moving averages, how prices are affected by them, what the rules for moving averages are, a lot of our other indicators. We're going to talk about MOBO with momentum breakouts. We're going to talk about snapbacks and a lot of things that we use to trade the markets. Tomorrow we're going to show you flats and how we can help start predicting directional movements of specific stocks from one day to the next, as well as what the high probabilities are for individual indexes themselves and the market, which way it's going to go. Your workbooks should have about 200 pages there. They're constantly changing. I'm adding stuff all the time to them. So as we come up with new materials, we drop some stuff and add new materials. And you'll see from class to class that happening, and you're on the list for the class again. So I try to keep the class updated as well as you updated, having been graduates of the class, and gives you the benefit of all the new materials. The website you need to look for, and it's on the workbook, is wallstreetteachers.com. If you have questions you want to direct to me about anything that we're covering, whether it's the classes, you didn't quite understand something, the pages in your book are missing, or I messed up somewhere, just get a hold of me through there. There's links in there, and there's the books in there. If you want Bigelow's book, click through there and you'll get the book for 49 or 50 bucks including shipping, and it'll avoid the $70 Amazon or whatever they charge at Amazon for the book and materials. So there's some bargains in there for you. If you do not have TCNet and you're interested in upgrading to TCNet for a month or two or trying it out, let me know. I'll give you a password and they'll send out a disk for you, and it'll automatically put you into our club, the First Wave Club, and you'll be able to chat there with us, talk. I'm there most of the time during the days and evenings and mornings and wee hours for the insomniacs that just can't go to sleep. I'm in there usually playing around late at night. So if you have an interest in doing that late at night and you want to do that, let me know. Pardon me. Thank you very much. And we'll have a book for you. We will go through and you staying or leaving? Okay. We'll talk later. Thank you. Thank you, Mark. So we'll chat with you there, and we do our Tuesday night chats fairly regularly where you get to ask questions also. So kicking this off, advanced equity trading. Learning is like rowing upstream, not to advance as a fallback. My observations about my own personal life, that if I don't try to keep up with stuff, I get further and further behind. And it became glaringly obvious to me, especially in the tech business, of trying to keep up with all this new software. If you don't keep up with the software, pretty soon it's like learning a foreign language, and you need to continually keep up with it. It's no different for the stock market, that if you're not reading and studying and going to classes and learning, you're going to slide backwards. And I think there's a reason that your mind needs to be challenged. You need to be challenged on the new things that we find out about the markets that are constantly going on all the time. I go to classes all the time. I go listen to Bigelow. I went to a GET class put on by eSignal here about 3 months ago. Any opportunities I get to hear or listen to somebody come to town and do a seminar, I go up. So I strongly advocate your attendance to your Cornerstone group and seeing and meeting as many people that can give you information about the markets. Obviously not everything we talk about, or at least those guys talk about, is going to have 100% applicable to you and your situation, but there's always some truths that you can glean from what they produce for you for the shows. First thing we're going to cover is moving averages and the secrets to buying stocks. If they go up, buy them. If they don't go up, don't buy them. That was by Will Rogers. And really, that's my concept about the market. And when I tell people that, a lot of them laugh and go, well, that's pretty simple. It was that easy. I mean, we'd all be rich. But what I want to show you is it may be that easy. We maybe have tried to make this stock market investing more difficult than it is. And I know, being a tech person from a long time ago, went through this phase where I had like 40,000 different indicators, and if 6,000 of them said up and 2,000 said down, I couldn't figure out what to do. I had analysis paralysis. And my objective here is to give you very clean and simple signals at getting in and out of the market, getting you large percent gains with minimum risk. And the big word is risk, that I don't want it if it doesn't go up. And what are the signals that are going to give us highest probabilities of stock going up? We're going to start with moving averages. I started with moving averages because back a couple of years ago, somebody asked me in the middle of this big crashing market, what's the definition of a stock going up? Because they were looking for stocks going up in a bear market. And I said, you know, that's a good question. And I had to pause for a minute or two, and I said, well, the old days, we used to talk about a good stock. It was above its 50-day and its 200-day moving average. So my homework, as a result of somebody asking me the question, my homework to myself was, why don't I go back and look at stocks that are above their 50 and 200-day moving average? And you can write a scan for that very easily. You know, close greater than 200, close greater than, and close greater than 50. And it'll give you a list of stocks above that. And in the down market, you know, you had like 3 of them. You know, one was Krispy Kreme was one of them, and Panera Bread was another one. Some of these weird stocks you wouldn't think of buying in a down market. They just kept going up, doing stock splits, going up and doing stock splits, and everybody that owned them that didn't know anything about the stock market was making tons of money. And all us guys that knew everything there was to know about the stock market were still losing, doing bad trades on high-tech stocks. So I went back and started examining that and going, well, is it when the 50 crosses the 200? My observations were, wait a minute, every time the stock hit the 50-day moving average, that was a point to buy the stock. Because I'm always looking in hindsight, well, when's a good place to buy a stock that's still in an uptrend? And what I was noticing was that if I looked at the 50-day moving average, when it came back to that 50-day moving average, it gave me an opportunity to buy the stock. The one on the screen right now is GE, just bounced off of our blue line. And our blue line right here is our 50-day moving average. And you can see right there that it hit the 50-day average. And what did it do? Bounced up. I didn't have any other good points to buy GE. And this is, well, this is on a long-term chart, on a quarterly. So if I'm looking at long-term, there's a quarterly chart. Let's look at the daily. Here it is on a daily. My best point on a daily to buy GE, I'll try not to stand in everybody's way, when GE broke out of the 50-day moving average. And you can see it came up, tested it, pulled back, and then had a nice candle over it, tested it again, and then we went up, tested the 500-day in purple, and then we had a nice big candle up over the 500 and came close to the 20 on the way up, and now we're sitting on the 20-day average. That's the kind of thing that I need to look for, and going, where's the safest place to buy a stock? When it's down, turning around and starting to head up. Well, at what point is that a turnaround? A stock that I like to put up an example for right now, this time period, if I compress it for you, if you look at this stock over the last several years, here's a stock that's gone up almost a little over $40, United Technology. And you can see what United Technology's done. Once it broke the 50 and the 500, it's bounced off the 20 and the 50-day average consistently. And in fact, if you look at it, what it did Friday was what? Bounced off that 50-day average again. Let's see. Is that better? Yeah, especially in the back there. If it's too much light in the back, we'll shut those blinds there also. So on a long-term picture, what if you missed the buy opportunity back here in April when the market turned around and you wanted to stock in an uptrend and you wanted that in your portfolio for more than 15 minutes or 15 days? What you need to look for are stocks that are bouncing off their 50-day average. Now, just because they hit it doesn't mean they're going to go up. So we're going to build a house here, a financial house for you, based around our moving averages as safe entry points, and then starting to introduce some other techniques around those averages so you can learn those. so that if you had no other tool in your toolbox, you could trade successfully just with the moving averages and price. But then we go one step further. We're going to add some other technicals down here. I have the window shut off because I don't want you to get distracted here with some of the other signals that tells us that every time we hit one of these moving averages, one of our signals told us to buy it. So we'll get to that point here some point this afternoon and this evening on when those points are. But without that, where would you buy this stock? Once you've seen the pattern here, you know that this stock likes the 50-day moving average, and if it successfully tests it and the price starts to go up, it's a good entry point. And that's what we're going to use as our test here. The other thing I've come up with is about 15, 18 rules on stocks. So flipping on over to our moving average page, we have some rules. Number one rule of moving averages: they act as magnets for price. Moving averages act as magnets for price. So price is attracted to the moving average, and they're attracted to each and every moving average that we have up. And we're going to explain how that works. I have some of them listed here. I have the 3, the 15, the 50, the 200. You can add two other majors. Now those are some fairly major, but we have some other major averages. We have the 500-day, so you write that one in, and we'll have to type that in on the next workbook. I also have the 1,000-day, and then there's a couple more for those stocks that really get creamed and bombed. There's the 2,000 and 3,000. You might find 1 out of 1,000 or 10,000 stocks that hit those. But our major averages are the 50, the 200, the 500, and the 1,000-day average. Those are the most common that we see interfacing with stocks regularly. On our screen right now, we have in yellow the green. The yellow is a 20-day. In a turquoise blue is our 50-day. Our purple or magenta is our 500-day, and our long white sweeping line on UTX is our 200-day moving average. You can make these any color you want. It doesn't matter to me. If you keep your 50-day at least blue, you'll understand when we talk about the blue ice hole test or failing the blue ice, because I look at that as a skater that's skating on the ice. And the ice here is a 50-day average. And at some point, this stock, as all stocks do, will break their 50-day moving average and present to us an opportunity or a pattern to make money on the downside as well as it's done on the upside. And it will be the reverse pattern that we've seen on the upside. If you turn this chart upside down, you would see that this chart is a chart of many stocks that you saw in the market from the year 2000 until the spring of 2003. That they went up and tested the 50 on the way down and failed, hit it and failed, hit it and failed, hit it and failed. So we have exit points or entry points for puts on the way down, and on the way up we have entry points to buy. My focus right now for the class is mostly on the buy side, because usually about 90 or 95% of the people in class cannot short stocks. Either they don't have the education to do it, or their broker doesn't allow them to do it, or they don't have the financial means to put that money up that their broker requires for them to do short stocks. So it's not that I don't like shorts or going negative on the market or trading the downside. I find that most people are positive biased to a stock, and that's where we'll do most of our focus. So right now we're looking at going and bouncing and being attracted to the magnets and then bouncing off of them. Rule number 2, prices are attracted from one moving average to another. So if I break a moving average, I will be attracted to another moving average. And I'm going to go through a series of stocks that we can do actually either randomly or off a list, but it really doesn't matter, that are moving off of their averages. Let's see if I've got some here on a personal scan. This particular chart that we have up right now is AEP, American Electric Power, and I've just pointed out the 200-day average, but on this particular stock in October was well above the 50-day average, and the 20-day, it broke the 20-day, it broke the 50. So Rule 2 says that they're attracted from one moving average to the other. My point being is, if I break the 50-day moving average, my next target is the next major moving average. In this case, it's the 200-day moving average. What does the stock do? In November, it comes down where our arrow is, hits the 200-day moving average and bounce. Its next attraction is the 20-day. If it breaks the 20-day, what's your next target? The 50. You'll notice the first time it hits the 50, what does it do? It fails the 50, pulls back, and then its second attempt, you see it jumps through it and has a beautiful run up, and it's staying above the 20, and in fact it jumps through the 500-day moving average. The first time it hit the 500-day moving average, though, what's it do for about 2 or 3 days? It has a pullback also, and it goes through that same pattern of failing the first time it hits it and then turning around and going back up. And we have an expression for that we'll talk about here in a moment. Does that pattern work regularly? Let's go back to the beginning of this chart in April and May of last year. The stock was way down in the 23 area and had a great buy signal off the 50, held the 20 all the way up, and it ran into the 200-day moving average. The first time it saw that average, what did the price do? It pulled back and failed. That's a common pattern. What did it do? It went down. If it failed the 200, where's your first target on pullback? 20. If it successfully holds the 20 and the 20 says we're not going to fail you here, where's it going to go? It's going to go back up and see if it can pop through the 200. And on that second test, we usually get a breakthrough to the upside. So that's a pattern that we have that goes up, pulls back, goes up, and we have a couple more waves on the upside, and then we go through this whole thing again. So what I want you to focus on is anytime we have an up move from a stock that's badly beaten down, first time it gets introduced to that moving average that it runs into, it exhibits this pattern of failure. It pulls back, and then it has that pattern of I'm going to break through. But even on the breakthrough, what did it do? Came back and tested just to make sure it was good before it had another rally, a little pullback, and then its final move up. So these are patterns that we can see regularly on moving averages all the time. Okay, let's put my glasses on so I can see the book. Short-term moving averages oscillate around long-term moving averages, and we'll keep coming back to that. That's Rule 3. Rule 4, first attacks on longer-term moving averages are usually repulsed on the first time. Isn't that what we just talked about? That first attack on the 200-day average, which we haven't seen in a long time, it was repulsed. It was attracted to it like a magnet, and all of a sudden the polarity reversed and it repelled it back to the next moving average like a magnet. Boom, it catches it. Now if this holds, we're going to go back up and probably break through that average. We do. We have a little pullback test of it, and then we're up and out of here. A significant move. This stock's gone from the low 20s all the way up to about 31 or 32, about a 50 or 60% move. Question?
The other class you were saying that if it doesn't break through on the second try, then it really goes back and resets the low.
Yeah, if we had failed here at this point, in this corner here in May, and let me put the arrow there so those of you in the back can see that. But the question is, if we'd failed here, where do you think the price was going to go? What would your target be? If it failed, if it failed the 200 here, the white line, where our arrow is in the yellow, my next target would be where? Back here where the 50 is kind of lagging back there in the weeds. It would come back and test that. And that's the behavior that we get out of these particular patterns. That it'll come, and we'll see some that do that, where they don't get through the second time or the third time. They may come back and test it one more time before they go up. Will it take this low out? Yeah, very likely it could come back, take this low out, test the 50, taking it out, and then reverse. So we could have a reversal there, and we'll show you some of those patterns. But I want to start setting you up for what to expect when you hit these particular averages the first time you hit them. Yes. Yes, ma'am.
If you go back at that date and once it touches the 200 second time,
Yes.
that day it looks like it is a double top.
Uh-huh.
Would you be scared to
Looks
buy
like a
it
double.
at that
It
time?
looks like a double top. Well, what if you'd been in the stock? What were you going to do when it hit up here? You were going to do what the first time it hit?
Sell it.
You'd sell it. So now it pulls back and you're happy you sold it. Then it starts back up. It goes over the 200, comes back and fails. So now what?
It's like a
You just watch it.
you will be scared.
Well, I'm not in it. Remember you said you sold it.
Right.
So I'm not scared of anything. I'm just watching price behavior.
We'll buy it back again at
I'll buy it back if it has a breakout off the 200-day moving average.
no, we buy at 20 and it
If I buy it here,
yes.
hit the 20.
And it goes over the 200
Yep.
that day.
Yeah, then it gaps back and holds the 20.
So we sell it
So
back.
as long as it's holding the 20, am I okay? It held the 20-day all the way up. So as long as it holds that, I'm still okay in the trade. If it starts breaking the 20 and the 200, then we're in trouble. And we're going to show you where this 20-day interplays with one of our other indicators, and that's our MOBO indicator, where we use standard deviation bands to tell us whether or not this is going to break, because the 20 in the MOBO band is going to tell us to stay in this trade all the way up until the rollover up here about where the 20 breaks, and we'll introduce that to you. So we're going to give you more clues about what to do here.
Because the candle also says it is
Yeah.
as
Well, we'll give you more clues. What I want you to understand, though, what the pattern is here as these things go up and down, not really what you're going to do as a trade yet. Don't think about that. Right now, I don't want you to think about you're trading this. What I want you to do is just, is there a pattern here that you can see in every time the stock does this on a moving average? And if you can recognize that pattern, how you play that pattern is what we're going to do a little later on today and tomorrow, how to play that. But first, you got to see the pattern. If you don't see the pattern, you're the team that loses the football game. A good quarterback, he knows when the other team's going to blitz because there's a pattern for it. And he knows when they're not going to blitz. If he doesn't see the pattern, it doesn't matter what he's got going on in their head because they're going to sack the guy and kill him. So until you see the patterns in here, it doesn't matter how you play. You've got to see the patterns to understand what they are. Once they are, then you can plan your attack. Do I get in? Do I get out? Do I stay in? Do I stay out? And that's what we'll get to on here. I appreciate the question. We need to see how these work. All right. So over here, we broke the 50 going into November. Came down, our target's the 200. Broke the 20 on the way up, tested the 50, pulled back. Next time it did what? Right back up. Actually, it gapped up and pulled back and closed on the 50. Next day, it gapped back up. It held our 20-day all the way up. Had a little hesitation at the 500. What do we know is going to happen the first time it hits a moving average? It fails, because one of our rules is, what is it? First attack on a long-term moving averages are usually repulsed the first time. This is very much like I tell everybody, it's like my old dating life when I used to date. I'd go out with a girlfriend or meet one, and the first night it was up to the doorstep and boom, slam the door, goodbye. Well, a week or two later I come back with flowers and roses, and she'd invite me to spend the evening wherever in the living room or somewhere talking about opera or something. So now we're in and we're moving up, and we see this pattern happening all the time. In the case over here in December, I came up, hit the 50, ran back out to my car. I had some ice, champagne, some good chocolates, and boom, she opened the door in, and boy, we got all the way to the living room. So that's a pattern that I'm seeing happening all the time. What I'm going to tell you is, you see this pattern that we hit it, we pull back, and the second time we go through to the upside. If we invert that pattern, that's a pattern that we're going to see, that we see all the time on markets that fail the 50. It's the same pattern upside down. Let's take a look at the next rule. Second and third attacks on a moving averages are usually successful. Rule number 6, prices that break moving averages often come back and retest the average before continuing in the direction of the break. So we'll look at a couple of those and see if we can find some stocks that test and fail. You get a second chance to get out, absolutely.
Sometimes I need that.
Yeah. I'll give you one that we gave in class here recently. A lot of you traded Ivan with us, and back in this June, we had that gap up move, and then again in August, somebody asked me in August, it was breaking out. I said, what should we be doing here? And I said, either be long or be wrong. This stock is running, and from the $1 level ran up over to over $7. We gave you the sell signal intraday on that up here where we had the big bearish engulfing candle. That day we told you to get out. We're starting to cover. If it breaks the open, the only kind of candle you'll get is a really big ugly sell candle. And indeed, you got bearish engulfing, and it gapped down, and it started going down. That rule number 6, though, says that once you hit a moving average on the way down, first time you hit it, probably what are you going to do? You're going to bounce, go up a little bit, then come back and test it and break it. Isn't this our bullish pattern except upside down? It is the same pattern. And on bullish stocks that have had great runs to the upside, it's very difficult for them the first time they hit the 50 to just slip slide right on through it. You got to have a Enron kind of thing or some disaster out there for them just to go from a $7 all the way down through 3, 4, 3, and 2 just straight down. Stocks don't move in straight lines, they move in waves. And we're going to talk about those waves today and go over those to make sure you understand them. So we broke, we bounced. I actually bought in here, bought the bounce, had it run up. Everybody thought I was crazy. And I wanted to show them, I know the behavior of stocks. They will bounce. We get out because I know I've got a day or two of very short life here on this stock before it does what? Rolls over, breaks the 50. Now I've broken the 50, it's a big deal. Let's look at another rule here. Number 6, prices that break the moving average often come back and retest the average before continuing in the direction of the break. Well, didn't I just break the 50-day moving average here on Ivan? Broke it pretty good, didn't I? What happened over here and over here? I came back up, and twice I did what? I retested the 50-day moving average. The second time sent me all the way back down to where I had a double bottom on this stock. And I tested the lows again. Typical behavior on a stock that breaks the moving average on a 50-day moving average, it likes to come back, especially a good strong bull stock that everybody just, everybody that never got in on this deal up here is looking around here thinking, well, maybe it'll go back up to the old highs. So they're in here buying. Big bullish gulfing and candle. We run up in December, fail. The second time in December, fail. And now we're on what I call an ice hole failure. And this is the pattern of failing the 50 after breaking it. That kind of test I call the blue ice hole failure. This blue ice hole is that when I grew up in New Jersey, we had great ice skating in the winter. But we had freshwater springs, and you had to watch those places because they were really thin ice. It looked really clear, but it was only like a ½ an inch or a quarter of an inch thick. So those you could spot in the day. At night, you had to be really careful and kind of know the general area. If you went through that ice hole, when you came up out of the water, under the water, you had to find that ice hole because the rest of the ice was too thick to break through from the bottom. There's no way you can push your hand to make ice break from underwater with nothing to push on. You've got to find the ice hole. Many people drown ice skating when they break through the ice, and they're stuck under there trying to breathe, and they just didn't go the right direction. The ice hole was there, and they went right. The ice hole was the left, they went right. This stock's trying to find the ice hole. It came up to it, didn't find it, tried twice to find it to break out. It failed, so now it starts to drown. So this is what I call failing the blue ice hole. Number 2, and I'm going to skip one of the rules here to one of the other rules. One of the other rules is that what we're teaching here is fractal. Fractal in the stock market means for whatever study we're looking at or indicator, that if you put it on a different time period of shorter or longer, it's going to work the same way. If this is a 10-minute time period and you have a double failure of the 10-minute blue ice hole, guess what's going to happen on your 10-minute chart? Exactly the same thing. What if it was a 5-minute chart? Exactly the same thing. What if it was a 1-minute chart? Exactly the same thing. What if you were looking at a quarterly or monthly chart? Exactly the same thing. That is fractal. It means it doesn't matter what time period you look at. It's robust, means it works over all time periods. And what I'm showing you today works over all time periods. So if you are a day trader and you're trading futures, this works on your futures minis, the big contracts, the pork bellies. If you are a trader that trades once a week or once a month and you're a position trader, it works for that also on long-term charts. So we'll be going back and forth, short-term, intermediate, and long-term, looking at these various charts to see how these interact with each other, so we can adapt this to your trading style. Because for the number of people in here, we have the same number of different trading styles. My risk is different than everybody else's in here, and your risk is probably different than everyone else's in here. So we're not trying to force everybody in the same shoebox. What we're telling you is, understand what the pattern is, and then you can adapt how you trade to what you see in the pattern. And for me, going, hey, bouncing off the 20, going up, I'm going for it. Or you might wait for a breakout and new highs, and who knows. That's dependent on your trading style, how much money you've got in the account, how many years you've been trading, and whether you're really cautious or not risk averse at all, and you like to jump in and do things. What do you think we were doing here? If we were long the stock in December on the lows down here, what do you think we were doing here where the arrow is when it hit the 50-day moving average? We were selling. And I gave you those prices. I had I'd gotten out up here the first time it hit, got back in, and the first day it missed that 50-day average by a couple cents. And I'm going, boy, sure hope it has one more attack on the 50, because I need to get out of this because I don't like the stock. I just know where it's probably going to go. What does it do? It goes through the 50-day moving average by about 2 cents. Lets all of us out, Trader A, myself, and the rest of you folks that were trading that. And then immediately, what's it do that day? Closes down on the day. Goes to the 20, has a half-hearted bounce, breaks the 20, and now we're heading down to these prior lows, which is a nice place to look if you want to buy a stock that's failing all these things. Look for some support. Right now, it's failed the 20-day moving average and looks like it could come back again and test the $2.50 area. So that's a picture of one that failed. Question?
How much history does it involve as far as, like, you know, it looks like it's going to try the, if you get to the point it's going to hit 50 again. Would that be considered the first time hitting 50 because it's been a length of time?
Yeah, there's been a length of time here. So the first time hitting the 50, again, I would expect it to fail. Suppose this week it wants to jump up. First time it hits the 50 intraday, you can bet there'll be 1,000 people out there that have been through my classes, and you know what they're doing, right? They're selling on the button, going sell it, market, or they've got their order in already, a couple cents off of there, and it'll hit, and all of a sudden you'll see the stock drop 10, 15 cents, and everybody will go, what happened? It just, and if they don't have the averages up there, they're going, what happened to the stock? It kind of like in midair, just turned around and went down, and it ran into the stone wall there. That's the pattern that we get. Now, those who were in class today, I said you need to copy a stock chart down and paste it on your wall. Who was that? What stock was that? What was it? Krispy Kreme. Let's look at Mr. Krispy Kreme. Why did I say you needed to make a copy of this chart, laminate it, and hang it on your wall? This was a blue ice hole failure. In fact, if I do flashcards, this guy's got to be on there. What do you think? Isn't that cute? Isn't that a perfect pattern of an ice hole failure? You break it. You almost hit the 200-day moving average. You bounce up. You run all the way back up to the 50-day. The first time you hit it, oh, look at this. How many times did we hit it? Didn't we hit it up here? Let's take a look at that. It went up there, and it was like, it just ran up there, got his lips burned on that one. It kissed it, and then boom, right back down. If you hit a period button twice on your screen, you'll come up with that little box. So I can see what a 50-day is. It says 41.48, and what was the high?
41.50.
It says the high was 41.50. Is that close enough? Within 2 cents, as soon as it got within 2 cents of hitting the 50-day average, it immediately drops and loses 50% of the move that it made that day. What did it do the next 2 days later? Went right back and tested it. How close did you get? Yeah, I went through it a ways this time. How far a ways? You hit a high of 444 or 41.44, and the 50 is 41. You missed it by 3 cents. How about the next day? 50 is at 41.41, and what was the high? 41.40. You missed it by a penny. My point is these numbers are so dramatic and so reliable that you will hit these numbers within pennies. Where most people, if they get within $1 of the top and the low and the turnover, they're happier than pigs in slop. We have the ability with moving averages to narrow these points down to within cents. Within cents. How many times did I fail now? 1, 2, 3. I got 4. I got 5 open on it and failed. 5 times I failed the 50-day moving average. Any clue about what you think it could do after that?
Gap up.
Yeah, gap up. Yep. What do you think, if we had studies up on this chart, do you think they're rolling over or just shooting straight up? They're rolling over. So part of what you're going to learn here is the pattern, and we're going to reinforce that pattern on what it's going to do at these major critical points with what your studies are telling you it's going to happen here. If it's going to gap through, your studies should be doing what? Pointing up. They should be at the bottom of the study, oversold and heading to overbought. These studies are doing what? You think they're overbought or oversold? They're way overbought. They'll be rolling over. And what happens on this pattern, I want to point this out. I think I have this pattern drawn up for you specifically, and let's move over to it if I can find the page. It's on page 17. Nope, that's the up page. Just keep 17 in mind. Blue ice hole. On page 35. 33. 33 is that pattern where we go up, test, go up, fail, and test. So there's the pattern for you. There's our 50-day average. We went up through it, we tested it, we came down, hit it, failed it, went up, tested it, and failed it. What you'll notice on that chart, that on this last leg down, it takes out the prior low. And what I'm talking about is, let me put the vertical line on it. The first break of the 50-day average, this was our low right here. What did we do? We made a low, went up, had a blue ice hole failure, came back, tested the 200 and did what? We broke it, and we broke the prior low. If somebody says, well, what do you think the stock's going to do? Is it going to hold the 200? I'm going, I don't think so, because I'm supposed to take out the prior low. So my next support level is where? The 500-day moving average. The first day it hit it, what did it do the next day? It bounced right back up. Isn't that what it's supposed to do the first time it sees a long-term average, either going up or down? It did. Next day it does what? Has an up move way up and then closes through it. And we have a series of days that keep trying to hold the 500, and finally it gives up. And we have some more ice hole failures, except this case it's on the 500 day. But this is a pattern I want you to become familiar with, is break the 50, rebound, come up and test the 500. Sometimes it's 1 day, sometimes it's 5. Fail it, the blue ice hole failure, now you're doomed to take out that last low. It's a predictable pattern. Is the stock going to make new lows? Yes. On a blue ice hole failure, you're looking for new lows in the stock. Two things you can do. If you were still in the stock, you got a chance to get out and save half the money you just lost on a rebound. Number two, if you're quick enough to play options, you could do what up here? What could you buy? You could buy puts. Or two, if you had a long-term strategy on a stock and didn't want to sell it, what could you do on your stock? You could sell what? You could sell calls against it, knowing that what's going to happen to the price of the stock. It's probably going to come back and take out the lows. You may want to cover those calls when it does what? Find some support. So there's a lot of plays here that you can do with that information based on whether you play options or not, whether you buy stock, and whether you can go short. A lot of plays here. So that's our pattern that we like. I love these blue ice hole failures, and that's what we look for all the time. Let's look at a few more. And let's see here. I'm going to pull up a list I've got. says blue ice hole test. Okay. This is Citibank, I believe. Where was I looking for it? Hello. May of '02. Okay. Let's go back all the way back to May of '02. There's a perfect picture of an ice hole failure. We have the stock doing extremely well for January, February, and March, running up, making some highs, but what starts happening up here? We start doing what? We broke the 500 in purple. We broke the 520 in one day. Is that good news or bad? It's bad. What do we know is going to happen if it breaks those two average? What's our next target? The next moving average. The next moving average is our white line. What does it do? Well, what does it do first? First thing it's supposed to do, first time it touches, what's it supposed to do? It's supposed to bounce. This has been a nice bullish stock for a while. It does what? It bounces, and where's its resistance now? The one that it just broke. So what we've got here is a 20 ice hole failure, don't we? You know, one of those thin ice puddles. And what we're going to see is a progression of ice hole failures here. I failed the 500, I'm failing the 20. If I fail the 20 and I've already had one bounce off the 200, what am I going to do? Probably go down to the 50, it's so close. And I slip through it. I have one bounce off of it, then what? I really break it. I make new lows in May. So here's our lows in May. If I go up and fail the ice hole again, what's my target for a low? The prior low. Knowing that if the stock's at $42.50 or $43, there's the $42.50 line. If it's at $43 or $44, what's my target on a short? That prior low, about $38, somewhere in there. At least it's going to go back down there. If you knew that every time you had a blue ice hole failure, could you make money on the downside? Absolutely. Stocks go up quicker or down quicker? Yeah. Do you run out of the burning building quicker when it's burning, or do you run in there when there's offering free steaks? I think we run out of the burning building quicker, like these examples here in the end of the year on Citibank, than we do in there when they're waving the, hey, come on in for a free cup of coffee. It's this fear and greed thing. And what's happening up here, oh, by the way, what do you notice about what's going on up here on the moving average? Let's put the arrow on there so you can see that. What's going on up here right at this point right here? What's happened? It bounced off a double moving average. Do you think it's harder to go through two moving averages from the bottom side, or easier? Much harder. That's like having a big ice freeze in the hole, and then you get another freeze of ice coming over to just freeze that ice hole up. What we effectively did is what? There's no more ice hole. We froze it up. Solid.
Isn't there a unfortunate candle up there too?
Oh yeah, there's an unfortunate candles up there, a couple of them. So can we get clues from candles on this? We'll talk about some of the other clues about what happens when they fail, and that's one of them. It's a hanging man doji. Not a good candle to look at, and certainly means the market's going down. So this again is a sell-off, a test of the 50 and the 200. We fail on both. Where's our first target? The first moving average. Yellow is 20. What's it going to do there if it has any support? It's going to do what? Bounce. If you look at the bounce, isn't that about 50% of that first down move? Everybody see that? It's about 50%, maybe somebody could argue 60%, but certainly about 50% of that down move. If that's a wave and you have a 50% rally that fails, then what are we in now? There's a wave 1, there's a wave 2, wave 3 starts down, we take out the lows, we have another rally to the 20, and what happens in the middle of June? We fail the 20 again and we start another wave down. And we keep having these 20 moving average day failures. Finally, we get sold off so much it reverses, comes back up, fails the 20, pulls back and gaps through the 20. So now we're watching it to do what? go up again and head back to the other averages. But in this case, it held that 20 all the way down. It's a good short, and we had some targets. Let's look at some more. I want you to learn these patterns. They're very simple patterns to learn, and they happen over and over again. Let's see, cat. And they aren't just happening to high tech or low tech or no tech. They're happening to all stocks all the time. They're happening to all indexes, all prices, all time periods. What happened to this stock? I put in a double top. Well, first thing I did, I put in a little tiny double top close together. Then what did I do? I gapped through the 20. What's my target? 50. They got within a what? A few pennies? Maybe a dime, 20 cents. What happened? Bounce, shot right up. So the first attack, we're probably not going to go through. It doesn't quite make a new high. It fails the 20. Where's it going now? Back to the 50. But what does it do when it gets there? Gaps through. 80 to 90% of all the gaps in the stock market are around the major moving averages. That's not written in your book, so you might want to write it down if you cannot remember that. Remember this. If you don't have your major moving averages up and you're watching stocks gap, you're probably watching it gap through a major moving average. And what do we know about stocks that fail major moving averages? Good news or bad? Bad news. So if you know what's going to happen when it gaps through an average and you've got your averages up, you have opportunity to make money in the stock market. If you don't trade options and you want to learn, trade with one on paper. You know, go get a quote on a stock that breaks a major moving average from your broker. There's some online simulation accounts you can do it. Go and play one for one contract. If you've been doing it for a while but aren't familiar with this pattern, but you're a competent option player, go play it with one option and see how much money you make on the downside. It's pretty phenomenal. And you don't have to wait all year to get your money. One of the reasons I like this pattern on the downside, it's instant gratification to your equity. It sees instant gratification. In a day or two, we see pretty good results, don't we? A couple ways. Now, can you have an up day on the way down? Yeah. Do stocks go straight down? No. They move in patterns. They move in waves. First time we come down to the 200-day moving average, and let me point, I'm going to blow it up and point it out because maybe you can't see that. Let's blow it up a little bit. First time I come down to the 200-day moving average, what happened? The stock hit the 200 and it bounced for what? 2 days? Actually closed up, and the next day it gapped up. Going, holy cow, we're going up here right off the 200. Happy days are here. But what happened? Gapped up, and what happened to the gap up? It failed. And a failure gap with a stock that has bearish engulfing, having once bounced off the 200-day average, is that a stock that you want to be considering being long in? No. Bearish engulfing candle, which means this dark candle swallows up the clear candle after it's hit the moving average once, is not a good sign. So there are little signposts the stock market puts out there to tell us maybe you shouldn't think about being in this stock. What if you got in it? You could get out and do what? Breaks the 200, could you just flip and go short or buy puts? Sure. So one of the things you have to do is maybe you got tricked here and going, well, it hit it and you forgot that rule that's supposed to bounce the first time and then test it. And you forgot all about that rule. And you're wrong and you went long here. What can you do immediately on that thing the next day? It gaps down on the open. Get out of your longs and do what? You made all that money back that same day. It was like, hey, you were down $1 or $2, don't worry about it. We're going to get back to you right away. Instantly. If you can be flexible there to do that, you can be flexible enough to make more money than you've dreamed of in the stock market. You can start eliminating these losses that you've had that go from one day to the next and turn them around. Intraday loss can be turned around to be an intraday profit. And failing this, and by the way, what did it do the next day? It gapped up on the open. Where did it open? On the 200. It ran up a little bit. Then what? Or no, it gapped down below it. Ran up to the above the 200. Closed on the 200. So you're going, oh, I don't know what's going to happen here. Next day it opens on the 200 and gives you another bearish engulfing. And we pull back. And then we have 3 more days and we have one of these wild spikes over it. But what happened the next day on the close? It gave you a huge bearish engulfing that wipes out 1, 2, 3, 4, 5 days of closes in one day. So now you have more confirmation that you shouldn't be long, you should be short. What if you just went short at the close here? Was that a good time to go short? Sure. Why do we know this is a good play? Because where's our next moving average? It's down here at the 45, 46 area. The magnet is broken at the top. Who's the new magnet? The next major moving average. Could there be some more averages below the 500 down here? Yes. One of the problems TCNet has is that it cannot put in a moving average over 500. So for moving averages over 500, we have to trick it by using a day bar. And instead of looking at a 1-day bar, I have to look at a 2-day bar. So if I hit the 2-day, it starts giving me some other averages. Pardon? Just by hitting 1, 2, or 3. I'm on a 1-day bar now, the number 1. So I'm looking for this July lows. And there's, let's go to the July lows. I think those are, So in 02, if I'm on a 2-day bar chart, what happened in here in 02? What is this? This is our 500 line, but I'm on a 2-day chart. What is that now? That's your 1,000-day average. Is that an important average for a stock? 1,000-day average is like a 4 or 5 year trend line. It's like a high water mark, a high tide mark, a flood mark. It's a big deal. What did it do here? It hit it. First time it hit it, what did it do? Bounce. Second time it tested it again, it tested it again, it tested it again. Last time it tested it with a doji. Is that a good sign? Yeah. And then what? You had a huge 2-day bar up, and it broke all your moving averages and took off again. So now back in the latter part of the year, what's happening now? It's testing the 1,000-day average. First time it hit it, what did it do? Bounce for 1 to 4 days. Bounce for a week. Keep hitting it, bounce, hitting it, bounce, hitting it, bounce, and finally hit it and broke it. So we can go back and look at these and going, is there another moving average down there? And we can just go 1, 2, or 3 and see, what average is that? I'm on a 3-day. The purple bar now is what? The 1,500-day moving average. Was that an important average for Caterpillar at the end of the screen here? Broke it and closed it. By the way, first time it hit it, what did it do? Oh, isn't that the pattern? Supposed to. But it came back and tested it. It held it on the close and then started to do what? Start up. If it's going to go up, do we have any targets even on a 3 or 4 day chart? Yes. So what's my next target? My blue line, my yellow line. Even though we're showing you a 3-day chart and that's a 15-day average, this one now is 150 and that one must be 60. So our charts, we would expect at some point to see the stock start to move over and head up to those averages. If it doesn't find, we got some more down here. 3-day, there's a 4-day. How about a 5-day? A 5-day is what? 1 week, 5 times 500 is what? Is there a 2,500 average in the stock's life? Looks like there was. What was a pattern when it hit the 2,500-day moving average? First thing it did what? Bounce. The second time it did what? Gap through it. This is a terrible stock. And it's Caterpillar. Holy cow. And they made out here in the Midwest somewhere. Big company. Big deal. Yeah, Peoria. Yeah, this is a heck of a company. But it's facing some terrible issues here. So what if I do a 6-day? Now I have a what? A 3,000-day moving average. What is like 3,000 is how many years? 200 and some, how many trading days in a day? A year, 220? 250. So 250 into 3,000 goes how many years? 12-year moving average. Is that important that it bounces off a 12-year? This is a big deal. If you're looking for supports on a stock, that's how you find them. If I can find support there, where am I going to go? My next moving average. First time I hit it, what am I going to do? Bounce and fail. Next time I'm going to hit it and do what? Pull back. Here I hit the 200 and the 50 times 6, whatever that number is. And what do? Fail, test it. Where do I go? Back to my 20 times 6. So it doesn't matter what time period we're looking at, we can find the supports for these stocks as they bounce and hit them, bounce and fail, hit them and bounce and fail. And I know that if I keep failing major moving averages, that I'm going to have some more out here. For those that weren't in the class, yes, ma'am.
Do these candles change with the time, like when they're counted?
Yeah, they'll change with the time period that you're looking at. Yes,
They keep changing.
they will. A 3-day will look different than a 4-day or a 5-day.
Like,
Oh, what, tomorrow when they add a day?
no, if you go in the back time frame, you see like a doji on a certain day.
Yeah,
But when you go and see like week later or something, that doji will change.
yes, it does, because they accumulate. The way Warden makes a week is different. You have to look at it on the same day each week to see the same candle. Let me answer it that way. So if you saw that doji on Wednesday last week, looking at some time period in the past, you will have to wait until Wednesday next week to see the same pattern on that same candle in the past, because they're using same time periods and they keep adding a day and dropping. So your candle will disappear for 5 days before it shows up again. Dow Jones times 30. Dow Jones 30 times, let's go back to
Therefore, the safest candles to use it daily.
yeah, yeah, but you can get a big picture, couldn't you?
Yeah, I've been using weekly, that's why.
Yeah. What if you were using a 2-day candle and you're looking at the stock market where I'm sitting there frozen, go, what the heck do I do? And you have a moving average of the 500 here, which is now what average? You're on a 2-day. The 500 is now what? The 1,000-day moving average. You're looking at this as a buying opportunity. I'm looking at this as like, oh my God, my career's over. I got people at Dean Witter jumping out of windows, committing suicide, shooting themselves. I had one of my buddies at Dean Witter in Boise shot himself with a shotgun. The manager at Dean Witter in Tacoma went out and shot himself with a pistol at lunch out in the park. We have people doing crazy things, but if they had the moving averages, what do you think? Would they be alive today? This is life-saving stuff, and I know it because I had people commit suicide because they didn't see this and I didn't see this. Now, I wasn't ready to go jump out a window because I knew markets come back. This was like Proctor was saying the market was going to go to 50, and they believed it. How close did this get? You want to see something that'll give the creepy crawlies, and then we'll take a break here. Guys, this is weird. Let's put it up. If I hit the period button twice, it tells me that the 500-day now, which is now the 1,000-day moving average, should be at 16,000 or 1,615.78. And the low was 1,616.21. What do we do? Miss it by 30 cents? 50 cents? Always room for improvement. In a market that was hysterical, people jumping out of windows and going nuts, the biggest percentage drop that we've had in a long time in the market, 1987, the crash of 87. The market found the 1,000-day moving average. And when I started doing my homework on this, going, well, I can see it today and yesterday and last year, these numbers work. But what about history? If this is going to work today and tomorrow, and it worked yesterday, If I go back and back test this and the behavior of these patterns, shouldn't I see the same pattern? And I see the same patterns happening over and over again. What is this pattern up here on a 2-day? We came down and hit the blue line. What did it do? Bounce. Second time, what did it do? How did it do it when it broke it? It gapped through it. Any clues what it's going to do? Yes. To me, this is powerful stuff. It's like I started getting goosebumps. I'm just going, oh my God, we just found the code. And to me, this is one of the codes to the stock market of understanding what it's going to do before it does it. Because wouldn't you like to have the Wall Street Journal today for tomorrow's market and next week's market? It's here. And in some ways, the whole performance of the stock market for now, for the next millennium, may be already printed out somewhere. We just only get to see it as it happens, but it may be already in print, like the Big Bang is. We're just seeing stuff from the Big Bang that happened, 10 billion years ago. How do we know that this isn't already printed out for us? It's printed out and it's telling us that we have certain behavior patterns and they're driven by humans. They reflect your emotions, and if you pay attention to them, you can make a lot of money in this market because all you're doing is reacting to what humans do when they react. And we will give you the points where you're going to buy and where you're going to sell if you pay attention to those waves. What I'd like to do is take a break here, and we'll take a 10-minute break, and then we'll come right back. All right, what we're going to do now is look at some more patterns, and we'll turn the lights back down here. We're going to look at some of the behaviors. Of the stocks. This stock is AEP, American Electric Power. Stock followed the 50 up for a while. Failed the 50, came back up. First time it hit the 50, what did it do? Failed it, bounced back or snapped back. Second time it came up, it did what? Broke through. And when it broke through, how did it do it? Everybody see that gap? Let's put the pointer on that. You'll notice that when it's time to go through the 50, look where it went through. What did we have going on here? Don't we have the 200 coming down to meet the 50-day? That's an important focal point. And later on in the book, we'll talk about these focal points. They're very powerful areas for stocks to make major moves. One of the places I'm seeing stocks make major up moves and major down moves are at these focal points where major averages come together with the price. So where I have price coming together with a major moving average, it's time to pay attention. And we just go with the flow. It gaps up. It pulls back in the morning. It bounces off the 200 and the 250, then does what? Starts back up. What if you wanted to go long on this move? Whoops, I just knocked down our transmitter here. Pardon me. Sorry, guys, on the other end. We have a gap up on the open. Somebody says, well, how do you play these? If I like that stock, it gaps up in the open, and I don't have a Dow that's screaming like crazy, typically what do stocks do? They come back and do what? Fill the gap. What you do is you put your buy stop above the open. If the stock wants to continue down and go and make a new low, are you going to get stopped into the market? No. If the stock turns around and runs up like a bandit to the upside, what's going to happen to your stop? You're going to get triggered into the market, aren't you? And it will trigger you into a market that's going up. So I like the market price action to get me in the market and get me out. And just go, I don't know what's going to do. I know it's supposed to be going up. We gapped up through two major averages here. It's pulled back a little bit. We'll see. I'll just put my stop above it. If I have the luxury of watching it during the day, first thing in the morning, about the first 45 minutes or half hour, if it gaps up and pulls back, it only takes it 15 or 20 minutes to turn around and take off. all these turnarounds where they gap up, pull back a little bit, these don't last. This big up move didn't move in the last hour, guys. 99% of these happen when they gap up and pull back. That pullback lasts about 15 to 30 minutes and it's gone. If you didn't get it, you missed it. Yes, sir.
How does pre-market activity appear on the chart after?
You don't see any.
Not at all.
Not at all. There's no pre-market.
So in other words, it doesn't end up in the whiskers or shadow?
No, you never see it. If you look at Taser, the highs that Taser made on the gap up and sold off, it had actually been 20 bucks higher that day. So it was actually $20 worse in the sell-off than the actual candle that you see to answer that. So we don't see that stuff pre-market and aftermarket in these charts. All we're getting is the real-time markets, because it could be one guy that did 100 shares up there at 20 bucks above everybody, just said throw me in the market, and nobody else was willing to, you know, do anything up there. So somebody said, hell yeah, I'll sell you my stock 100 shares for 20 bucks more than they paid for it. Question. Right here? Yes. No, the major moving averages are the 50, the 200, the 500, and the 1,000. There are minor moving averages, and we have the 100. We have the 300, the 400, and we have another one I call the 80, and we'll look at that because I've just found out the 80 is a very important moving average for us when we're looking at the 50-day. So there'll be some ports here that you'll see. But for right now, our major averages are the 50, the 200, and the 500. Then the 1,000.
How about the
Exponential. I don't use exponential. The reason people use exponential because they're waiting for what to happen. One moving average to do what? Cross another. They're not waiting to see prices cross exponentials very much. I don't get these kind of patterns where it tests the exponential 50 and fails and pulls back and stuff. It doesn't happen. It doesn't happen. The only exponential I will look at is a 200-day exponential because 5% of your stocks will play off the exponential. So for the 5%, I do use it. The rest of them that they're using exponentials on is just a waste of time. They don't see the, number one, they don't know what the patterns are. And number two, they're waiting for some magic around exponential numbers. The market does not see exponential numbers. It sees simple moving averages. What we're looking for is, am I looking for the yellow to cross the blue to sell here? No. If I waited for yellow to cross anything, what did it get me to buy here? Right here? I'm telling you to buy it here. Why? Because on price action. We're looking for our arrow here for the gap up over the blue, which is our 50-day, and the jump over the 200 is our buy entry. Not where the yellow crosses the white or where the yellow crosses the blue that gets you in way higher. This stock could have flipped over at any time here, and it still may flip over. Where are the safe places to get in? Off your major moving averages, successful moves. Had we bounced off the 500 down here on the lows, that would have been an excellent point to start nibbling, and you could have added on the way up.
That was right at the 100.
Yeah, okay, the 100 was down here? Good.
On a 2 days. So.
Okay. So there'll be other averages down here that you'll see that do show up. That we'll look at as we add on. I'm trying to get you familiar, one with the pattern and the pattern around the major averages. And then we'll start adding some more averages here. Let's go and look at a couple more rules here. Page 17. That's our move up number, right? Yes, question.
You were working, that was a 2-day that you were using, right?
Yes.
Could you quickly go back to 1 day?
There it is on 1 day. I'm sorry, I meant to be on a 1 day. So it's on a 2 day. There it is on a 1 day. Does it change anything? No. Actually, what it changes here is you came down and where did you find support? On the 200 day. So I found support here on the 200. I go up. First time I hit the 50, what do? I fail. So the second time I come back, and what do? I go through it. I actually gap through it and close right above it. What happens the next day? It gaps up. So on this day right here, and I want to point that out, what did this market just tell us right here at the close? Somebody said it telling us it's going up. What are the things telling us that it's going up?
Got a lot of bullish pressure because you got a long tail on
Well, you got a long tail on it. What did I just go through on the second attempt? I went through what? 50-day moving average. And what kind of pattern is this? It's a kicker. Anybody that doesn't know what a kicker is, please write down this stock. AEP, American Electric Power. Look at the first and second day that break out over the 50-day moving average. That is a kicker. A kicker candlestick on the first day one that we look at it, the close is below the open. You get a dark candle or a negative candle. The next day, the open is above the prior day's open. What happened? It reversed sharply. I like seeing kickers at the bottoms off these down here, but I'll take one off the 50. What did I say in class today? A kicker off the 50-day average, is that a good sign?
Yes.
Absolutely. This stock, how good was it? Well, it was like one of the best days this stock had, and the rest of the time it just crept up until it hit what average? 500, and it fails for 1, 2, 3 days, and then what? Takes off again.
So you're saying that where the arrow is, that's an opening above the previous day's high?
No, it's an opening above the previous day's open. Kickers look at open to open. Kickers look at open to open. Let me explain that a little better. If I don't know how to do this, does this go up? We'll see if this goes up. Okay, maybe it's electric. It's probably on a motor. Well, I don't know what's going to make it up. That looks like the sound. That's the sound. So anyway, we'll draw some diagrams for you here at break time. But a kicker always is where you have a negative candle where the open and the close have this pattern here where you have the open and you close below the open, and the next day your open opens above the prior day's open.
That is a bearish kicker of the last day.
Is that a bearish pardon me, yes. Actually, yeah, I would have liked to have seen that be a negative candle, but that is well, I need the close to close above the open also for a positive kicker. Kind of a negative kicker. But our point is I got a kicker coming off of what? A 50-day average. What's my target? What would my target be looking at the 50-day and somebody says, well, I'm thinking about trading this stock. It's around 28 plus, 28.50. How much money is in this trade right now that you can see? Your answer is, well, where's the 500 at? It's about 30, 31, 32. I'm at 28, 32, $4 on a $28 stock. Is that worth the trade? Should be. $4 on $28 stock. How much is that percent-wise? About 15%. So there's a 15% play. That looks like it's worth it for me to play it because price is a magnet. We've been broken through the 50, and we're being repulsed here and being attracted up here to the 500. How you see that hand?
Does it make any difference how big that kicker is?
The bigger the kicker, the better. Yeah. And in this case, it didn't take much because we were over what? We were over the 50. If we had a kicker just out in the middle of no man's land, I want to see some action here. But we have a kicker off of something solid. This is why somebody says, well, what do you want to do up here? I don't want to do anything up here on this stock in the middle of nothing. There's nothing there for me, right? I'm not bouncing off the 20 and I'm not failing anything. It's just not a stock I want to play with. We have some other bands and we'll look at and say we may want to be getting out of this stock if it starts to roll over. But I certainly don't have anything that tells me I want to be long or a safe place to get in. There are safe places to get in, then there are safe places to get in. Pardon me.
So in other words, when over the 500 here, that isn't the case.
Goes over the 500. Oh, absolutely, I'm long. And to add on to my luxury of such a great position, it closes the next day with a kicker. I'm going, hallelujah. If you're in a stock, it gives you a positive kicker after going over the 500-day moving average. Just sit back and watch the money come in. It's coming. Wind. This was almost a kicker. Look where it closed. It opened here, closed down here, and the next day it almost opened above. I called that an almost kicker. Everybody see that? Let me point it out to you. See where the arrow is right now? That was an almost kicker. The open was just below the prior day's open. Had it been above it, you would have had a perfect kicker. Here's a kicker, the prior low. Almost. But we got a kicker here that almost a kicker, and it closes up. Next day it does what? Big move up. How about going through the 500? Did it with enthusiasm or not? What did I say about gaps? Most gaps happen around the major moving averages. If you didn't have your major moving averages up, you're going, it gapped up and I don't know what to do. If it gaps up over the 500-day moving average after breaking through the 50-day average the day before, is this stock going to go up? Absolutely, positively. We made tremendous money on this. What did it do up here? It gapped up, then what? Failed the gap, so we have a pullback. And this is our wave 2 pullback, which ended, and we had another run up. So we could have gotten out up here when it broke the open. Let me put the candle on there so you can see it. We broke the open up here. So if you got out anywhere up there on the open or just below the open, you had the opportunity to get out, watch it come back, and when we get into our hourlies, you'll find out that we came into an hourly 50-bar average that was down here on the lows. It gave us a chance to get back in, and then watch the daily go back out and do another wave up. If we counted waves, I got a wave 1 up to the first arrow. I have a pullback of 2-3 days, then what? A nice wave 3. So what I want to do right now is take a quick review of what are the wave counts and candlesticks for moving up and down. They move up and down in waves. So let's look at how those waves move. What we're going to look at is also available on your Yahoo site. And if everybody's on it, great. If you're not on the Yahoo site, we'll put it up for you. But this is posted on there, and you can go back and copy this and put it in a book or on your laptop or wherever you want to put it. It's a free site, the Yahoo site, so there's a whole bunch of stuff like that. Waves in prices are only 2 ways that a price can go up, and these waves that we look at in the stock market, this is one of the ways that goes up. We have a wave up. We have a pullback. A lot of the time it's 50% or 61%, a Fibonacci number. We end that and we start a wave 3. So anytime we have a 3 or 4 day upthrust in the price of a stock, what am I thinking all the time? I'm looking for what to start happening. I'm looking for the next wave, and what the next wave will be a correction. And I have the choice there of sitting in the correction for the 50% pullback and giving up the $2 or the $5 that I just made, or getting out, waiting wave 2 to be over and getting back in as wave 3 starts. I'm going to show you where a lot of these patterns go up, pull back to the 20-day average, tell you when they're done, and the 20-day average or the Bollinger Bands, they turn around and you start wave 3 up, and they're safe re-entry points. Let's look at a couple examples of just some stocks. Boom. Sienna has a wave 1 up, a wave 2 down, and then a wave 3 up. How do I know that wave 2 is over on this pullback? What are some of the hints? A bullish engulfing candle is a great hint. What else happened after the bullish engulfing candle? A gap up. What if I drew a trend line off these tops of those candles? What do? You broke the trend line. So I have about 3 good things going on. What do you think the volume's doing? Getting bigger or smaller as this candle gets bigger and we gap up? What do you think it was doing on the pullback? Getting big, smaller volume. So for those of you that like to look at the volume, would have seen on this wave up, as we got close to the top, the volume started to get small. Then the volume started to get big, and by the end of wave 2, the volume got small again, until finally wave 3 starts, the volume gets big, and as we get up near the top, the volume starts to dry up as buyers start leaving the market. And it puts in a top. That's how these patterns happen. If you understand that, it makes it a lot easier. Here's a wave 1 up. How do I know wave 1's over? It starts to roll over. I get some dojis. I get some hanging men. By the way, right here at the end of this first arrow wave up, I have a hammer, and on either side of it, I have dojis. And I call a hammer with a doji a Shanghai duo. And we'll talk about those. Shanghai duo came from the Shanghai Nights movie. I call this little hammer guy Clint Eastwood from Hang 'em High. He's hanging on the tree, hung, till the sheriff comes and cuts him down. And this is Jackie Chan. So anytime I have that, it tells me the market's getting ready after a good run, getting ready for a rollover. How do I know it's over? I get a bullish engulfing white candle, don't I? What else do I see happening? If I do a trend line there, what happened at the bottom of the down arrow? I have a trend line break. What else did you see? Gap up. To have a gap up like that, is volume getting bigger or smaller? Has to get bigger, because these are buyers coming to the market, and on the open they're willing to pay any price. It's market order on the open to make a gap. They're not limit order guys, they're market orders.
Somebody's got to be insane.
To put market orders in on a stock on the open, are they excited about something? Yeah, I don't know what it was, but they were excited enough to turn this around and start wave 3. By the way, is wave 3 quicker and steeper than wave 1? The answer is yes. Keep that thought in mind, because we're going to look at the downside, and we're going to have to look at wave 3s also, and you may see a parallel conclusion. Here's one that did a 1, 2, 3, 4, IBM. Did a little sideways move on wave 4, and then wave 5 had a nice run up with some Shanghai duos and things up at the top. If we have a pullback on a wave pattern, then the alternate wave pattern on an up move is you go up, you don't have any pullback, you just move sideways, nobody wants to sell, the shorts can't get out, and then finally the stock starts moving up again. We had tremendous examples of this, and we'll look at some other stocks. Here's one of Dell. Has an up move, goes sideways. How do I know the sideways move is over on wave 2? What starts to happen? Where are the wicks and the candles? On the bottom, the candle's getting smaller. Yeah. And what happens when it starts to take off? What happened? It gave me another gap, little tiny gap. It filled it, but it was still a gap to start with. And I get what kind of candle on a breakout? Nice big candle. Another indicator. I'm in wave 3. So this thing should go up approximately at least what wave 1 did, and maybe more. Lycos. Go up, go sideways. I broke the gap, or I broke out with a gap. If there's 2 ways to go up, what do you think about the way down? How many ways down would you think there would be? 2. If we went up and pulled back, well, on the down wave, you go down and pull up. I do a move down. I pull back 50%, and then I have a wave 3 down. Doesn't this suspiciously look like the pattern for a stock that breaks the 50-day moving average? Anybody agree? Because instead of being 50%, what if this was a 50-day line? And I come back on a wave 2, and I fail wave 2 at the 50% line, then I'm starting wave 3, which says what? To qualify as wave 3, I take out what? Wave 1, and I have a blue ice hole failure. This is the wave pattern that we're seeing on failures of the 50 or the 200 or the 500 or the 1,000-day moving average. And they're really easy to see. And which wave pattern makes you the most money?
3.
Number 3 is dynamite. If you like to make a lot of money fast, learn a little bit about options and puts. And just look for stocks that fail their 50 on a wave 3 failure. Apple Computer. Guys, by the way, all these examples I'm showing you, I traded. Apple Computer, or I got September of '02, puts in a doji at the top, sells off, I get a wave 1 down, I get a wave 2 up, and I get a wave 3 down. And then the earnings come out, and you look at the bottom of the screen down here, and the stock drops about $25 or $27 in one night, in an hour. The biggest drop I've ever seen in a stock overnight in my life.
Did you have puts on that one?
I had 5 or 10,000 puts.
Oh my God.
Not personally, but money I was managing. It was enough puts for one client to go out and buy me a brand new 2001 430 SEL right off the showroom floor, with the 888 double-decker Tranger in the back and the heated seats and the navigation, all that stuff.
But the candle on that before the drop is very positive.
Kinda.
How would you think of
I stuck it out because it didn't fill the gap here. It failed the gap down here, and I'm still in a wave 3. Do you have up moves and down waves? Yeah. I had some other observations too. In fact, I still have the same observations, so I don't know if it's really valid, but I'm looking at Apple Computer at $62 a share. And in 2000, in that summer, I'm in Costco, and they got an aisle of Apple computers. And they have an aisle of Compact and all the other computers. And I look in the aisle of Apple computers, there's nobody in the aisle. And I look in the aisle of all the other computers, and everybody's buying them and hauling them out. In fact, in my whole life, I've never seen anybody take an Apple computer through a check stand. It was probably an invalid observation, but it was an observation enough to me to say, look, at 62 bucks a share, somebody's got to be buying it, and I got to be seeing it with my own eyes. I'm going, what's with this taser thing? I'm not seeing anybody buying them. Is something going on here I don't understand? So, I don't know. But I get this huge sell-off. I'm in puts, by the way. It's after hours. When's the option market open the next day? What time? 9:30 Chicago time, or Eastern time, and what is it here? 8:30? 8:30. In that time period from 4 or 5 o'clock in the afternoon to the next day, could this stock have rallied up 20 or 30 or 40 point or whatever? Could it come all the way back and my puts gone from huge in the money to list a little profit? Yeah. Normally that's what happens. So how do you protect yourself to lock in those profits at 5 or 6 o'clock at night? I have puts. Option market's closed. Where do I buy a call at? I got puts. I got thousands of them in my accounts and everybody else's. What if I don't have money to buy the stock? I got all my money tied up, and I got 10 contracts. Every dime is in. I bought them up here. I bought by the way, we bought the $55 puts, and they went to 27. Is it a good move? Yeah, terrific. I got all my money tied up in those puts. How do I lock it in? If you can talk to a broker, you tell them you want to do what? What is your right as a person that owns an option? You have the right to exercise. Does it say you can only operate the exercise between the hours of and the day of? Does it say that? You can exercise anytime. If I own a piece of real estate and I want to exercise my option to buy the real estate, does it say I can't call the guy after the hours of 5 o'clock or 3 o'clock in the afternoon and tell him I want to exercise my option to buy real estate? No. Could I call him on a Saturday afternoon? If I can find him. If you can find your broker and you can call him after 4 o'clock and it's 5 or 6 o'clock, call him up and say, I want to exercise. What's he going to do? He's going to simultaneously buy the stock and deliver it to the OCC, the Option Clearing Corp. What are they going to do with it? They're going to deliver it to who? Whoever wrote those puts and thought writing puts is a fun thing, you can't lose. Because, hell, if you do, you just wait till expiration day, right? Wrong. Anybody that goes naked on a put can get the stock put to them at any time of the day or night by guys like me that are sitting there going, I want to lock in my profits right now.
They say after hours, this is something that
That's what we did. I didn't know this thing was eventually going to go down to 10. Thought, shoot, normally don't they fill gaps? Yeah. So we took off half of our positions out of those thousands of tens of thousands of put options. We took half of them off. We bought the stock. We had the broker buy the stock and deliver it. What happened when he bought the stock? I sold the calls at 55. What price do I get? Whatever he bought the stock for. The difference. Because when who's actually buying the stock? The guy that sold the put. So I'm exercising my right here to get out of these puts, and I'm getting 27 or 28 or 26, somewhere in there, whatever it's doing. And the volatility, by the way, was like 40 million shares traded in the aftermarket. It was such a big drop. So if you're ever caught in a position where you have puts on a stock and it gaps down overnight, and you're waiting at 415 and it just falls out of bed, could it bounce and have a nice rebound? If you think it can and you want to get out, just tell the person, I want to exercise my, you'll pay commissions on them buying the stock, but you won't have to sit there and watch this bounce $3 or $10 and lose that opportunity to lock in a large gain. And you might want to do it on half your position, or if you're just not greedy and go, heck, I'll just take all the money right now. You can play the bounce on the way up. How late can you do this? How late does your broker stay there? Depends on your brokerage house, that's all. The only restriction is, can somebody pick up the phone on the other end, and do they know what the word exercise my option means? Okay, that's the only definition. How do I know it works, guys? I did it. Got pictures of the car. My wife didn't like it that much. She's like, I went and bought a bunch of old ones now. She didn't like the new ones. I got a couple of older models, but that's what happens. Question?
This guy goes back to a question this morning about starting an account again. We go back before the first arrow. Would you have been counting prior to the last 4 or 5 days or so? Would you have been counting that as wave one up and
That's a great question. But if you remember this morning, the quiz question was, what was the first quiz question? What was a sign of the stock market rolling over in year 2000, and what date did I give you? September 2000 was a double top for NASDAQ. Am I wave counting for going higher or down? Wave counting down. The top, we had a double top. In fact, see this July top? The NASDAQ was just a little bit better than the July high that you have on the screen. It was an exact double top. Apple actually took out its highs by 1 day. You look at it here, had a 1 day up, sucked everybody in, then what? Rolled over. You take out that 1 day high, was that in that little doji, did you have a double top? Yeah. If you look at that, and I tell people, if you want a picture of the perfect double top, go back to the year 2000 on the NASDAQ for the months of July and September. I saw the sell-off. We had the rally. I'm going, if we're lucky, what am I looking for a good sell signal in a year that I predict we're going to have a market crash? The perfect double top. You heard the movie The Perfect Storm? That was the perfect double top. So if you want, we'll jump over and look at that. Yeah, hold on, let me just pull this up here. So what I'm going to do is pull this over to 2000. Isn't that a picture of the perfect double top? And by the way, what kind of candle did they put in at the perfect top? called a hanging man. Clint Eastwood hanging out. So to answer your question, was I looking for? I got a 1, 2, 3 wave count on the way up here off of a big M, off of a double top, and I'm looking for the signal to give me the markets in the crash. Some of you don't know this. I wrote a book called Everyone's Guide to Making $1 Million in the Year 2000 Crash, published in 1998. So I didn't just come to the party late. I was 2 years early, predicting a market crash to happen. I'm looking for this. I've got everybody playing the market to the long side, and everybody went to cash on these 2 days here where we had this last gap up going into these highs. And I'm going, I don't know if it's going to hit it and flip or give me a day to get out, but we're just getting the cash. We're going to take 10% and start playing puts, and the first puts we played was Apple on a 3 wave count. What am I doing here? Double top, and what do? I fail the 200, I fail the 50 with what? A gap. I go down. What did it do on the way back up? It gives us what? A bounce, an ice hole failure, and a wave down. On our selling wave, on the way that a stock goes down, doesn't it go down, retrace, and go down? Isn't that the pattern? Yeah. Because the only other thing it could have done is gone down and gone sideways on the 50 and down, because that's the only other way a stock can go down. So what I'm showing you on wave counts is a perfect match for a stock that fails the 50, rebounds and tests the 50 and fails in wave 3. As soon as it takes out the lows of the first wave, now you're in wave 3 and heading to one of your other longer term moving averages. In this case, happened to be the 500-day, way out in October before we had a bounce. Stock market had one of the sharpest sell-offs in its history between September and October of 2000 before we saw a bounce, and it was off of the double top. So those of you that like to keep pictures and patterns and put them in your book, take a picture of this pattern, July to September of 2000 on the NASDAQ. That is the perfect storm sell signal for the start of the crash of NASDAQ. NASDAQ was at 4,200. Where did we go on the NASDAQ in the end? Break 1,000? Yeah. We had a 90% or 80% drop in NASDAQ from these highs. And that was the signal. And it did it in waves. Did it go straight down? No, it went down, it came back, kissed the 50. Now, I didn't know it at this time. I'm just doing wave counts going, I don't know that it's bouncing off of 50s, 100s, none of that stuff. Kind of got lucky, but I was counting the waves. So you got Proctor people counting waves, but they don't see the moving averages. They stuck their moving averages, and then they go, holy cow, now their wave count counts for me. A lot of times they do wave counts that are just goofy. So nice move. How about this middle move in here on the first top? Break the 50, come up, fail it, and it takes the second time to get through to do our double top. And just look at the candles on the way down. They aren't good candles. That breaks the 200 with a big dark candle, gaps through. This is negative. And where are we going? We're going to go and take out that prior low. Took it out nicely. How about back here in June on NASDAQ? We went through the 200-day moving average, and how did it do it? Holy cow, somebody must have come out with some good hype on their fundamentals, right? Pepsi out there shipping those trucks to the front parking lot. Or I just can't believe this stuff that these guys are doing. Very creative. I got to give them credit for that, right? In fact, somebody should put a book in there of how to creatively cheat the public. You know, put Pepsi in there, put General Mills in there, put all these guys in there. They're coming up with some ways I would have never thought of. One of these days, NASA's going to figure out a way to do it, and they'll be parking shuttles on the back side of the moon. Right? We go, they don't lose them. They're just hiding them back there. Yes, sir.
How come that big gap didn't act as resistance on the way down to the first dip down?
Right here?
Yeah. No, the one to the left, big gap there. Wouldn't that act as support on the way down?
Well, the big picture was the highs for NASDAQ, which are actually 5,000. There was a prior fill on it. So what did we do the first time we broke the 50? What did we do? You bounced, right? And then what did it do? Came down, had another. Tried to do an ice hole failure, couldn't even get close to the ice. Came down and did what to the 200? Hit it, bounced, and then you just started going sporadic here. A lot of noise in here. but jumped over the 200 and you had a nice trend up, made a top, pulled back. Now I'm just looking at, I've got the start of a sell, I've got a double top here, and as my screen's scrolling over, I'm going, guys, this looks like the Twin Towers of New York to me. This is death. This is murder, this market. If we're looking for a rollover, these are two perfect tops. I couldn't get, the market was too weak to go back to 5,000, but it gave us a good double top. Failure of the 200, failure of the 50, both at the same. See, this time it had to fail on one at a time. Over here on September, it got them both in one day. Went through one on one day and gapped through the other one on the next day. Is that a good sign to be going higher? You can go buy the puts, go on vacation. You can sell a lot of calls. Because where's your target? My target's right down here, that I should get a bounce down here for another play to go long or short and continue to play this. So those are our plays. Let's cover the rest of the rules here. But there's our pattern on up-down rules on our wave count. Have I finished waves here? I think I have a couple more. One or two more, we're done. So there's a down. Here's an up, down. How do I know wave 2 is over? What's it do? General Motors, here's 92. It goes down, goes up on wave 2, and how's wave 2 end? Wave 3 starts with what?
Yeah.
Big gap and on down. Could there have been a moving average in here? What do you think? I'm going to guess that if I go back and look at this chart, that I either have a 100-day, or pardon me, a 200-day or a 50-day moving average right there. And that we gapped through one or both of them. And that earlier we bounced off of it. This example that I was using here was just to show you wave counts without any moving averages. Now you stick the moving averages in, they mean a lot more. So wave 1 down, up, go down. This time, instead of going a retrace, we go sideways. There's only two patterns, either sideways or retrace. Up, down, and drop. Schwab, Intel, up, down, and drop. And by the way, when they drop, if you don't read this stuff right, it could be a very heartache to wake up the next day and find out wave 3 started with a $15 gap down. So there's our other pattern, is just to go sideways, go down, go sideways like General Motors. GM, another pattern on General Motors. And that's it. So we'll go back to our charts, modern history. A little test. I'm looking at November. If the stock's going to go up, what's my target? I'm looking right here at the bottom of November. If I get a buy signal on my stochastics or whatever we're using that I think the market should go up, what's my target? The 21st. And if it goes through the 20, what's my target? Well, the 50 and the 200, what do they do? Oh, intersect. Do you think you're going to go through the 20, the 50, and the 200 the first time you kiss it? No, you probably get a pretty good shove back. If you're a person that wants to play that, could you have gotten out when it hit the 20 and the 50, waited for a 50, oh, isn't that a wave count? 50% retracement. That's pretty nice. The next move up, wave 3, is going to start, and how do I know wave 2 is over? It does what? It gaps through the 50, it gaps through the 200. Is that a good clue? Isn't that the examples we just had on wave counts? Same pattern. Let's blow it up for you because I see some of you squinting in the back. Put the buy-in on the gap up. You could put the buy-in, probably the safest place is to put the buy-in as it gaps up over the 50. I'm in here, over the 200. So I'm in at 730 and the stock goes to 10 bucks. What's that? 270, $3 on $7 stock. I don't know, it's 30-40%. Didn't take long, did it? A wave 1 up. I remember I said the stocks like to go in waves, a little wave here, another wave up, and the correction came back to what average? Came back to the 20, and what kind of candle did we get at the 20-day average? You see what that is? You got a bullish engulfing on a correction back to a support average, which now the 20 is a support average for wave corrections. So one of the things I'm seeing on waves and pullbacks is on a strong stock, if they're very strong and they're not a weak stock, they'll only pull back to the 20 and go higher. If they're a weak stock, they'll hit the 50 all the way up, and they just don't have enough. It'll take the strength of the 50 to get them back up there. It only takes a little nudge of the 20 to get this thing to go higher. So those are two patterns that I'm seeing regularly, is on these wave counts, that sometimes the 20 will hold it. And how do I know it's going to hold it? A bullish engulfing candle gives me a good clue. Ford liked to test the 20 on the way up, then finally broke it, went to the 50 and broke it. Pardon me. General Motors. What was important about General Motors back in November last year? Trailing along the 50. Sometimes it fibrillates, like it's got a heart attack. It's going back to 2050, 2050, 2050, up over to 20, heading up to the 500, and I'm going to gap up. You want to own it when it gaps through the 500-day moving average on a major General Motors blue chip stock of the Dow? Yes. You think those guys with all the computers understand what's going on? I think so. We like it when it's over. So if you got in over 44, you had a run to 54. $10 on a $44 stock is, I don't know, what, 20-some%? Yeah, almost 25, 22%. Got a couple big flat top up here, and then what do you do? You started doing what, hanging man and dojis? What's that? Clint Eastwood and a doji. Shanghai duos. I break the 20. What's my target when I break the 20?
50.
I go to the 50 and it kisses it that day, and then what?
Yeah.
Well, what did it do at the end of the day? Did it close at the 50? It bounces off of it. It still bounced, even though the next day it gapped through it. It kisses the 50 and bounces right back up. Next day it gapped through it. Same patterns we expect to happen over and over again. Unfortunately, we're seeing a lot of stocks now do what? Starting to break their 50s and rolling over and not doing nice things. Remember I said a stock goes up, consolidates, comes back to what line? Nearest moving average. Who is, in this case, the 20-day moving average, all the way up. Who is this? This is Halliburton, HAL. How do I know I'm making a good move over the 50-day moving average in December? Good candle or bad candle?
Good candle.
Good candle. Let's go to some of our rules now and review some more rules that we've just picked up on some of these pattern behaviors, so we can get out of the 220, the 50, and all these moving averages and start moving on. We next have, for rules, once an average has been penetrated, it becomes support for upward breakouts. Once an average has been penetrated, it becomes resistance for down moving stocks. So once I've broken them on the downside, what do? They become what? In the case of Halliburton back here in November, it went up, failed the 50, tested it, and what happened? Failed it. Came back and opened below the 200-day moving average. And it says, well, once you break it, now you're resistance. Once I've broken out, if it comes back and tries to test it, it's done what? It's now support. It's the same rules that you understand about trend lines. You understand a trend line. If you break above a trend line, it comes back and tests that trend line, it becomes support. If you break a trend line and you come up and hit it, now it's resistance. And if you have support and resistance lines horizontally, once you've broken above them, now they become support lines. Once you've broken below them, they become resistance lines. This is no different than if you were looking at a horizontal support and resistance line. The same kind of rules. Once I've broken above it, I look for the 50-day moving average to become support on the way up. And if it's a good, strong stock, when it moves over sideways on a wave count, isn't this wave 2? Let me put the arrow and tell me where wave 2 ends and wave 3 starts. What kind of candles do I get over there, by the way? Double dojis. I think Stephen Bigelow, who wrote the book Profitable Candlestick Trading, would just jump up and down on this one and go, you had a wave 1 up coming through the 50, pardon me, you have a 2-day pullback, and what do? You bounce off the 20? What kind of candle is that after a double doji? Bullish engulfing. I like that. Bullish engulfing, candle jumps. Was that my computer? Well, why is that? Is the battery not plugged in? Is this not on down here? Probably not. Let's... No, there we go. Yeah, I had it plugged into the wrong...
Get it plugged into the cart?
Yeah, the cart's not plugged in, I guess. There we go. Nice for it to tell us it was low battery. So now I have supports on wave counts. If this is wave 1, this is wave 2, this is wave 3, this is wave 4, this is wave 5. I got 5 wave counts. That's nice. Nice 5 waves up. Now it's trying to do what? Test on the way down. So if this is wave 1, the end of wave 2, double dojis and bullish engulfing, what else did it do the next day to tell you wave 2 was over? Yeah. Isn't that our example on a wave 2 move that starts to wave 3? How do I know wave 2 is over? Bullish engulfing ends the doji trend. How about if I do a trend line there? Did you break it? Perfect. Isn't that like a triangle also? Yeah, so you got all these things you already cumulatively have learned about the stock market over the years that you've studied it that you can apply to resistance and support coming off your moving averages to apply and go, well, I got a wedge going here, I got double dojis, bullish engulfing. What do you think your technical studies were doing? You think they were heading straight down or curling up and giving you new highs? What do you think OBV and all those MACDs and money stream were doing? Were they heading up or down here? All heading up. So more confirmation this is a safe entry. If you got out at the top up here at 27, you get back in at 26 for wave 3. And some nice bounces on the way up. Continuing to move to the upside. More rules. Let's get through the rules. Rules. Okay, 8. Once an average is penetrated, it becomes a resistance for downward breakouts. We did that. Stocks in sideways moving patterns often bounce between the 50 and 200-day moving averages like the Pong game. Just back and forth, back and forth, and back and forth. We almost have it here between the 50 and 200 where you go back and forth on the early part of Halliburton. And I don't know if I shrink this chart enough if it does that, but a lot of times you'll see these stocks just fibulate back and forth until they can break out. In this case, it just went from the 50 down to the 200, back up to the 50 before it finally broke out. Sometimes they'll do that for a long time, then finally they break out of the cage, and whichever way they break, that's the side you want to be on. This stock's fibulating back and forth, boom, breaks out of the 50, you want to be on the long side. If it broke out and down to the downside on the 2, you want to be short in inputs. Just bang, 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 boom, breaks out. So we go with the breakout, price confirming what we were looking for in a pattern. What if it gapped down? Well, it didn't confirm going up, so we're not looking to go long. I was looking for Eastman Kodak. There it is. Eastman Kodak. Banging back and forth between the 20 and 50 until what happened here in the middle of November, December. Back and forth, and then what? Gaps up. Is that a big candle?
Yes.
Big candle. Has some gaps. Where are you going to go? Like somebody says, what's your target for Eastman this next week? Well, how long did it take to get there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. That kind of a intermediate swing play trader kind of guy, person that would trade that? Sure. So if you like those longer term plays, you can go, okay, I got a target of the moving average. It's now back here. It was back about 27.25. If it takes a week or two to get there, that moving average will probably be about 27. So at 24 to 27, $3 on a $24 stock, I'm in. If I'm doing options, $3 on 10 contracts is how much in the money? $3 grand. $3 grand, is that worth it? Maybe. First time it hits it, what's it going to do? Yeah, it's going to pull back. It's going to fail the first kiss. He runs out to the car. Well, in this case, you got to go down to the quick stop. Which happened to be right here at what moving average? 20. That's a quick stop. Goes to quick stop, grabs the flowers, grabs the chocolates. These are C's candies. Fresh bottle of cold duck. Boom. Gaps up. Next day, what's he doing? Blowing right through the 500-day moving average. But we don't like to do that on the first move, so what happens? She says, wait a minute, I didn't invite you to the bedroom. Tells me to get back out there in the dining room or the kitchen or back to the living room. Wait a minute, guy, you're getting a little too anxious here. I come all the way back and now I've failed the 500 because I'm not supposed to go through that the first time. You kind of open the door and let you peek, but you don't get to run back to the bedroom. So I'm back downstairs going, okay, we're in here now. What are we trying to do? We're trying to decide if we're going to fail multiple tests of the 500 and go down, or if we're going to gap through and head up. So if we have a big dark bearish engulfing candle here, what's your guess of what's going to happen? Going to go down. And what's your first major average you're going to hit? 20, and then the next one? Major is 200, and the next major is... So we could hit both of these the same day if the prices move over. What's going to happen on these two moving averages? They're going to converge together. We'll get a focal point. We'll give a focus for the stock to go to. A great price for it to stop on a down move. Moving average and trend lines are often complementing each other. Haven't we been saying that? Yeah. We can draw trend lines that absolutely follow some of these moving averages. And we'll see a lot of examples of those. 11. Successful penetration of a moving average are often identified by big candles with flat tops and flat bottoms going down, flat tops going up. They have gaps. Son of a gun. What else comes with gaps? If you have a gap, you have an increase in volume. You should have huge candlesticks. I'm talking, 5, 10 times the volume we had 1, 2, 3 days ago. It's shouting at you going, volume, we're going nuts, we're going to gap up, we're rocketing out of here, get on board, you want the move. How about this break over here on Eastman Kodak when it broke the 50-day moving average with a huge dark candle? Was that one to just like hang around and ignore? Don't ignore these ugly candles that we have back here in October on stocks like this, 27 to 21 in 3 days. You want to make some money on puts, fail the 50. And I don't know why it gapped down. I don't care. Look how long it took it to come back. It took it months to come back, and it only took it, what do you get, gratification in 1, 2, 3, 4, 5 days before you got double dojis? Where do you get out? I got double dojis. Okay, I'm out. If you had nothing else to look at. We could look at different time periods. So could we go in and look at a 2-day chart, 3-day chart, 4-day chart? If I look at the 2, 3, or 4, or 5, I can just keep going down and seeing, do I have any other moving averages down there? In this case, the 500-day was so far up there. In fact, I'm on a 8-day scale, and it turns out the 8-day times 5 is what average? The 4,000-day moving average in 01 was impenetrable for this stock to break it through, so it just decided to do what? By the way, you went, yeah, I don't know what happened here. You went down, you went up, tested it, and failed. What did you do? 01, you took the lows out. First time you hit the 50 average on a 8-day chart, what did you do? Bounce right back. Bounce, I usually say, is up, so I say pull back. If you say bounce to me, I think you mean up. So I failed and I pulled back as soon as I kissed it. So the same things that we see in the long term or in the short term also happen in the long term. I'm on an 8-day chart. And we'll see the same patterns whether I'm on a 1-day chart, a 2-day chart, a 5-day chart, a 10-day chart. And evidently that was a major moving average for that stock. I want to show you something else. AVII. Anybody remember that one? Yeah, wasn't that the one that we were all going to retire with our summer homes and stuff on?
Yeah.
Everybody laughs at that. Stephen Bigelow is a great candlestick person. Unfortunately, at that time, he had not been to my class. And I was telling something to some people that maybe they ought to consider not going long the stock last summer for a couple reasons. Last year, we broke the 500 and it looked like we were going higher, but I said, you need to watch out because what's going on? I'm on a 2-day chart now. That purple line is now what? Instead of 500, it's a 1,000-day moving average. The first time you hit a 1,000-day moving average going straight up on a parabolic stock, what do you think is going to stop it on the way up? A moving average, a big one, 1,000-day. The stock hits it and does what? Drops $2 overnight. That a big deal for anybody that bought it at $7? Did they get stopped out? God, to hope. Gee, I just kicked it off again. I'm going to watch that. You would hope that these people watch this stuff and listen. I told them, do not buy this out. It's going to new highs, because they're looking at this old high back here in '02 and going, oh, it broke 650. This thing's projected to go higher. Buy the breakouts. How many people heard that expression? Don't buy breakouts if you've got a 1,000-day moving average 50 cents above the breakout high, because guess what it's going to do the first time it hits it? The rule is death. So just let them go and go crazy, and you'll just watch those guys. By the way, they're not here on the chats with us anymore. Those that are on TCNet, all those guys that were on those hot stocks that were going to go to the moon, they're gone, buried, dead. The account's gone. They're day traders, scalpers. Can we scalp? I think I am a great scalper if I wanted to be, but I'd just be focusing my life just trashing back and forth and in and out. And we know that 99% of all scalpers in the end end up losing, because they churn from scalpers to, I got to hold it overnight because I'm losing money on the position. Everybody I've canceled for the last 25 years or 27 years that was a scalper that lost money, the reason they got wiped out and lost everything was they went from being a scalper where they're in and out, and then they had a trade they were losing money on, they'll just hold it overnight for a few hours. You know, I'll just hold it overnight. So I've got 10,000 contracts here at $7 because they got stopped in at the highs of the day. Somebody said to buy it. 10,000 shares, and it starts to come down, and I'm just going to hold it overnight. And the next day on 10,000 shares, I'm down $2. I got margin calls, and I'm losing my everything here. It does it twice. Double top failure of the 1,000-day moving average. Is that a good number to fail on a stock that's 7? No. So the stock goes down in the toilet, and this is why I frown on people that promote scalping like it's something you're going to be successful at forever, because human nature is not to take your losses and go, well, it looked like it was going up at the close, I'll just hang on overnight and I'll turn from a scalper into being a swing trader. Pardon me. Yes, scalping is stock goes up a dime or 10 cents, you get in and out. You're going to like day trade it. A scalper is a day trader.
Until he becomes an investor.
And until he becomes an investor. And you switch from day trading to becoming, well, I'm an investor now because I got in up at the highs, and it's like, oh, I hope you come back. I'll give you another example of that. This one is AVII. This is the one to the flu, mosquito East Med flu or something, or East Med Nile flu, West Nile. Okay, East Nile, West Nile. How about this one? That's Ivan. Let's go to modern times. Memory lane. This is the daily chart of Ivan. What's the rule? If I'm going to start selling off, and by the way, did I get some bearish engulfing and sell signals and breaking the 20? What's my target?
50.
First time I hit the 50, I'm supposed to bounce. The next time I'm supposed to fail, I break. So if I break, what's the pattern? If this is a big wave 1 down, what's the next move up? A wave 2, and then what we have? We go into a wave 3, and wave 3 is supposed to come down and test our lows of wave 1. So isn't this a pattern of stock moving down? And by the way, we had 2 tests of the 50-day average. One you can hardly see after the big bullish engulfing. One up. You want to know how close that got? Trader Abe and I are sitting there just giggling. This is just hysterical, because you got all those people going, oh, the stock's running up, it's going higher. Going, yep, you need to bail out, right? Whoops, what happened? Am I not hitting the period here? I guess not. There we go. So the 50 is at 434 and the high was what? 433. Is that close enough? Within a penny. We went through it, I think, by 2 or 3 cents over here before we did what? Came back and took out all the gains we had. Not a nice play when you fail the 50 and fail the prior day's open and you close down on the day. So if you hit the 50 and you close down on the day, is that good or bad? Generally bad, yeah. Especially in a stock with no earnings and never drilled a hole that's had any well in it or oil in it or what, who knows. It's almost like a .com stock. What if it breaks the 200 over here? Where's it going to go? Yeah, I don't know if you heard that. He said 0. It could be. Could be. But if we break the 200, obviously is our first support is going to be down here at the 500, which somewhere is between $1 and $2. So our first major support is still coming up rapidly here. So when he saw, and by the way, on this little bounce off the double bottom, what was our resistance? The 20. Yeah. So let's finish up some more average numbers, and then we're going to talk about some other indicators, and we're going to take a break. Channels can often lead to supplement moving averages and trading decisions. So we're going to talk about putting in some channels. The channel I'm going to talk about putting in is our mobile bands to give us more decisions on breakouts and breakdowns. Next, number 13. Most, if not all, major moving average breaks are signaled with SOAP signals and technical divergences. So as part of building our house, we've got a good foundation now for what the pattern is for the floor plan of the house. Now we're going to start building the walls, the roof, and everything else on this house, so we have all the other charts down here and technicals to tell us what's exactly going to happen at these turning points. So there's no question in our mind when we get here that we're going to bounce, and when we get over here, we're going to break. Next, we use wedge and triangle patterns are often found at major moving average breakouts. We saw that in wave patterns. We get these little triangles at the end of wave 2, and wave 3 breaks them out. Rule 15, when we use 3 and 15-day averages, because research shows it to be better and most robust. So if you want to use a crossover, also use the 3 and 15-day moving average. They do work. And I look at them in like hindsight to make sure that everything's cool. But on these sharp moving stocks, they go through those averages pretty quickly. But I do know for people that do want to use crossovers on moving averages, the 3 and 15 are very, very robust signals for breakouts to the downside and the upside. 16. Research shows that the combination of 1 and 5 average ratios are on price are the best averages. So 3 and 15, a 1 and 5, a 2 and 10, any of those combinations of 1 and 5 are good average combinations. A 5 and 25. What if you're using a 5-minute and a 25-minute crossover? That would work. Or a 1-minute and a 5-minute. Or a 3-minute and a 15-minute. If you're a day trader. Next rules is getting down to the last 17 channels used with 3 and 15 averages often give us more reference points. We'll use those. How about those stocks that make new highs and there are no moving averages to give us references where they're going to turn? What can we use? We can use Bollinger Bands, we can use channels, and we can use shorter term moving averages to tell us when we're going to have a rollover, as well as candlestick patterns like gaps and gaps up and gaps down. Number 18, moving averages are fractal, and we talked about that. It doesn't matter what time period we look at. They're fractal. They work on all moving averages. So with that, we're going to take another break.